Hello, and welcome back to Equity, TechCrunch's flagship podcast about the business of startups. I'm Rebecca Balan, and this is the episode where we bring on industry experts to help us explore a trend in the tech world and dive deep. Today, one of those trends is the state of the venture capital industry. And to help us understand that, I'm talking to Bradley Tusk, co-founder and managing partner of Tusk Venture Partners. Tusk is also the founder of political consulting firm, Tusk Strategies, and he recently launched an equity for service firm for early-stage startups. Bradley and I talked about why he's decided not to raise a fourth fund, why VC has been dead for the last 4 years, how political turmoil affects the markets, and his initiative to bring mobile voting to the masses. Okay, Bradley Tusk, welcome to the show.
Hey, thanks for having me.
So I was really excited to talk to you for a number of reasons. I mean, you're the perfect person to talk to about the intersection of policy and tech and also what's happening in the VC space. And you recently made a decision to not do a fourth fund with your VC firm. Can you walk me through that?
Yeah. So, I've been a tech investor in kind of two different ways over the last 15 years. The first is how I started out, which is working with tech startups in return for giving them regulatory help, like helping Uber legalize ride sharing or helping Clear get into airports. And I was taking equity in return for that. Then in 2016, I launched my first traditional venture fund, and just a typical 2 in 20 fund with outside capital. We did 3 funds plus a breakout fund. And as we were gearing up to do the first close of Fund 4, I kind of took a step back and said, hang on a second. Is this good for me? Do I want to do this? And what I realized is I actually made more money when I was doing equity for services, because even though obviously there's less leverage than there is on a venture check, you keep 100% of the proceeds, right? Whereas in traditional venture, I've got to return the investment capital to investors. I've got to repay the fees. Then I've got to give them 80 cents on the dollar. Then I've got to split the carry with the other people doing the traditional VC functions here. And so it just wasn't, at the end of the day, nearly as lucrative. But much more importantly, the thing that I'm interested in and have enjoyed doing in tech and hopefully add some value is, how do you legalize disruptive technologies? How do you create the right regulatory framework for new technologies? And the thing that I also was spending a lot of time on that I didn't particularly enjoy was all the real VC stuff. Fundraising, LPs, compliance, board seats, portfolio construction. And there might be people who really love that stuff. I'm not one of them. And when it hit me like, oh, I can just do the stuff I like and I'm good at, make more money and stop doing the stuff I don't like, then that became a pretty easy decision.
How long did you do just the kind of traditional VC? There was 3 funds so far, so.
Over a 9-year period. And look, the final fund, Fund 3, has an investment period through 2031. We will have invested the fund long before then. But there's activities that are still ongoing. There's follow-on investments. There's boards that we're on. There's the platform work we do. So nothing changes for our first 3 funds in terms of our founders or our LPs or anyone else. The only difference is I just chose not to do a fourth.
And how many assets under management do you have in that last fund?
Well, 140 in the last fund, about 300 total. And one of the things that I realized is, at least from what I can tell, that's the wrong size for a fund.
Why?
Because the math doesn't work on either side. So if you are a giant fund with billions of dollars and the management fees are tens and tens and tens of millions of dollars, the people doing it are being compensated really well for their work, kind of regardless of liquidity in the venture marketplace one way or the other. That's not necessarily aligned with LPs, but it is the reality of the really big funds. Or if you can run your fund on a shoestring budget and have a $30 million fund or a $40 million fund, and you're doing pre-seed and seed deals and you get a few right, then you can be in carry, and that could be really great too pretty quickly. But for us, because we were providing all this regulatory work, legislative, communications, procurement to our portfolio companies for free, I got to pay people to do that. And so as a result, the management fees that we took in, we basically were spending to run the fund itself. So it wasn't particularly lucrative from that standpoint. But the hurdle was also high enough that a bunch of things have to happen before you're in carry. And so, at least for me, when I realized that I could just as easily get on tech cap tables and get equity from startups that I like in return for my expertise, the traditional model just didn't make a lot of sense.
Okay. And so it's equity for services. Is it cash ever or only equity?
I mean, it's basically equity. If there were something super late stage, maybe we would take a mix of cash and equity. And where this is a little different than, say, the first time around when I did this is now that I've run 3 funds, I do understand this stuff a little better. So the nature of our work's a little different in terms of how the regulatory stuff fits into the bigger picture of raising the next round and the burn and go to market and lots of other things. And then also, if it's early stage, I might write a balance sheet check out of my own pocket into a company. And then we're also asking our companies for pro rata so that if all of a sudden it's a Series D and there's a $10 million allocation that we have, I still have my LP base from my first 3 funds who would all be happy to take a look at any individual deal and decide whether or not they want to co-invest in it. And if we do those, we'll take carry on those.
So how many people would be working for you for this equity for services type of fund?
It would be we're looking at 7 plus me.
So I guess the question there, is how does it work? How do you keep the lights on? If you're not paying for management fees,
I got to pay them.
Okay.
Yeah, well, no, I have to pay them. Now, look, my first business, which I started in 2010, is a political consulting firm called Tusk Strategies. They run big campaigns all over the U.S. for big corporations, for often when we do work with late stage tech startups, it is Tusk Strategies doing it for cash, or they're doing it for big institutions. And I'm lucky that that's a really profitable business, and that gives me the flexibility to choose to reinvest that money in other things. And typically that's been sort of the stuff out of my foundation, or I opened up this very, very money-losing bookstore and things like that suck up the money. And look, if it turns out that there's a couple of Series E companies where we're taking part cash and part equity and that covers some of the costs, that's great too.
Yeah, well, I'm glad you bring up the consultant firm, because I was going to say, how are these exactly different in terms of the services that you're providing?
The services aren't really that different. I think it's a question of really expertise. Most of the work we're going to do in the equity for services world is going to be earlier stage companies that could never afford the consulting firm, right? The consulting firm is typically charging $75,000 a month for their services, which obviously an early stage tech company can't do. And so the nature of the work might change a little bit in that on the venture side, it's really how do we either pass legislation to say that what we are doing is legal, or make sure they don't pass legislation to say it's not legal, or if there need to be regulatory frameworks, how do we set those? If you need licenses or permits, it's obtaining those. If it's a product selling into government, how do you build a procurement function inside of the company itself, comms, things like that. But, fundamentally, if you came at this from an entirely different field and you looked at what Tusk Ventures is doing and what Tusk Strategy is doing, I don't think you would draw that many distinctions. To me, there's all kinds of distinctions, but I live and breathe this stuff.
Yeah. Okay. So then going back to some of the companies that you've worked with, Uber is a huge one that, you just mentioned, and also that I think a lot of people know about. But for those who don't, do you mind just giving a brief rundown of how you helped Uber in the early days?
That was my original entry into tech. So I started my consulting firm in 2010, and about a year into it, I'm sitting in a Walmart meeting and I get a call from a friend who says, hey, there's a guy with a small transportation startup. He's having some regulatory problems. Would you mind talking to him? I get on the phone with them. I become Uber's first political advisor that day. Travis then calls me back and says, listen, I can't afford your fee. Would you take equity? I didn't even know what equity meant, but thank God I said yes. That was back during the Series A. And then I spent the better part of the next few years running campaigns all over the U.S. to legalize Uber and ride sharing. And the thing that we figured out that really worked was that we could turn our customers into political advocates. And through the app, we were able to mobilize millions of people to tell their elected officials, hey, I like this Uber thing. Please leave it alone. And even though we were at the time a small tech startup and taxi was a very big politically powerful industry, we were able to overwhelm them with real people. And that's how it worked.
Did you advise Uber on their kind of cowboy approach to let's just get in there, get into these cities, and then we'll...
Yeah, to a certain extent, look, there's the big debate was, do you, in generally in this stuff, but especially on Uber, is asking for permission versus begging for forgiveness, right? Mm-hmm. And asking for permission, there are times where you need to do it. In fact, my first book, The Fixer, spends a bunch of time specifically kind of analyzing all of the different components of this. But look, let's say that you are a fintech company and you need a banking license of some kind in order to operate. If you were to start offering these banking services without that license, you're probably looking at a 7-year jail sentence, which means you're going to ask for permission and wait till you get it, right? Or when we invested in Lemonade, the very first thing we did for them, which is get them their licenses from each state to sell insurance, because they just couldn't operate without that, right? But if you're Bird and the ramification is they confiscate and impound a scooter, or you're Uber and they impound a car, not the end of the world. And so oftentimes, as you're trying to decide which one to do, there's not necessarily a right answer. There's a bunch of different factors, from what's the risk that you're taking, who is it that you would either need permission from or begging forgiveness to? What are they like politically? How close or not are they to the entrenched interests that you're disrupting? If you're in a white space where there is no entrenched interest, what are their views on sort of technology and innovation more broadly? Does this fit into their agenda? And there's a whole bunch of different factors. And the reality is none of those factors differ from industry to industry and startup to startup. They even differ from city to city and market to market.
Mm-hmm. And just to give our listeners a bit of background, so you have quite an illustrious career in government. You were the deputy governor of Illinois, right?
Yes.
And you oversaw the state budget there. I mean, what you're describing, I mean, it's interesting how you kind of straddle the line between tech and government, and you can see how you can kind of just push the levers a little bit in a way that we're seeing on like a mass scale, obviously, in the US.
Yeah.
How is the way that you've kind of played this a bit different than what we're seeing with Elon Musk and Doge at the moment?
First of all, the first thing is the vast majority of tech regulation in the US is run by state and local government, right? So the federal government has a lot of say around things like crypto. Elon is obviously both making huge changes to the federal workforce and probably, hopefully, going to bring in some new technologies that can make government more efficient. But by and large, whether it's education or healthcare or energy or legal tech or transportation or gaming or whatever else, most likely it's going to be regulated by the state or maybe the city that you're in, which is good and bad. It is bad because you have to go deal with 50 states or hundreds of cities. It's good because you don't have this single choke point like DC where all of a sudden some member of the U.S. Senate puts a hold on your bill because they don't like it, and then you're just dead forever, right? I actually prefer dealing with things at the state and local level because, when the phrase an act of Congress is synonymous with a miracle, like I can't base a strategy on a miracle. So it is actually very rare that we will invest in or take equity from a startup if the only way to solve their regulatory problem is through some sort of federal action. I'll usually just walk away from it in those cases. Now, look, Washington comes up and oftentimes, our portfolio companies have to do something and we'll deal with whatever it is. But that can't be sort of the driving point. Also, the key thing that we learn with Uber and we often replicate in others is city council members, state senators, state reps, they don't really get that much attention, right? Most people don't know who their local elected officials are. They don't talk to them ever. And so on an issue, whether, we did this for Uber, we did this for FanDuel, we did this for Ease, we did this for Bird. If you can get a passionate customer base and mobilize them and have thousands of people tell a state rep, a state senator, a city council member, hey, I really like this thing, that has a massive impact, right? Congress is a lot harder because they just hear from so many people about so many things. So like TikTok tried this, for example, and it didn't work particularly well. But if you can have registered voters from their district calling and texting and emailing them and saying, here's who I am and here's what I'm asking for, that could be incredibly impactful.
Yeah, well, I guess then when you talk about educating voters about what's going on, what's going to be on the state ballot, one of the things that you want to do or that you told me that you'd like to do now that you're not focusing on a fourth fund is to focus on things like mobile voting.
Yes.
And so do you imagine one of these apps providing all of the information that a voter might need about all the local issues? Like clearly you're approaching this from a local bottom-up approach.
Yeah, exactly. So I started this thing called the Mobile Voting Project in 2017. And the first thing we did was because when we were running all these Uber campaigns and all these people who were weighing on our behalf, like I hit this moment of like, wait, God bless these people. My guess is they actually have no idea who their city council member is. They don't vote in state Senate primaries. They're busy, right? They have kids, they have jobs, they have lives, they have stuff to do. But then when we made it really easy, they did. So the question obviously became, well, would they vote this way? And so we started the Mobile Voting Project and we did pilots in 7 different states, red and blue, where either deployed military or people with disabilities were able to vote in real elections on their phones using the technology that existed at the time. And it works. You had soldiers from West Virginia stationed in Afghanistan or people who were blind in Denver or in one election in Seattle. Everyone was allowed to do it. And over 2 cycles, turnout tripled. And so, to answer the question, like, yes, just like everything else that anyone listening to this podcast already knows, when you put things on people's phones and make them a lot easier and involve technology, adoption increases, right? That's the fundamental tenet of what we all do. And then the next question became like, okay, the tech that existed worked for kind of small groups, But if we want this to be available at scale to everyone, because the reason this matters to me is right now we live in a world of extreme polarization and extreme dysfunction. And the reason we have that is because of gerrymandering, which I think most of the listeners probably know, but it basically lets the two parties divvy up the legislative districts. As a result, the only election that usually matters is the primary, and primary turnout's typically like 10 to 15%. And who are those voters? They're the furthest right, the furthest left, or they're special interests and know how to move money and votes in low turnout elections. And it gets us one of two types of government, either the chaos and dysfunction of Washington, D.C., or just totally one-sided governments. And whether that's the state of Texas on the right or the city of San Francisco on the left, I would argue that none of that's good, nor is it necessary, because when you look at most issues, we actually agree. It's not like Americans are split down the middle 50-50 on everything. Like, let's use guns as an example. The vast majority of Americans would say we should neither confiscate everyone's guns, but nor should it be easy to just walk into a store and walk out with an assault rifle. Mm-hmm. But the problem is the people saying that don't vote in primaries, so the politicians ignore them. They only cater to the extremes who either want all guns or no guns, and nothing gets done. And then when the next school shooting happens, which it will, we're all going to bang our heads against the wall, and we're going to say, why can't our politicians just do the right thing? Why? Because they're held hostage by the extremes. You're only going to free them from that if primary turnout goes from 10% to 30%, where all of a sudden it's reflecting not just the far right or the far left, but the mainstream of people. And the only way to do that is to increase turnout. And the only way to do that is you got to meet the people where they are, and that's on their phones, right? Everyone has a phone. Everyone runs the rest of their lives on it. And so we started 4 years ago building our own mobile voting technology that we're just about done with, and we're going to make it free and open source. And so any government wants to use it, they can. It'll be a government app, not a private app. And local boards of election will be able to offer voters the ability to choose to vote in elections on their phones, in addition to voting by mail or voting in person or whatever else it is. And it is, we think, a pretty sophisticated system that includes end-to-end encryption, end-to-end verification, multi-factor authentication, air gapping, facial recognition. Everything is open source, so it can be audited and verified. So our hope is that once we put this up, we can get people interested in it. And then the next phase is passing legislation, starting with cities around the country, to allow everyone to vote in intermunicipal elections on their phones. And that's going to be a really big battle, because if you like things the way they are, if the status quo works for you, you're not going to want to change it.
It'll be hard to convince people that it's safe as well, right? And people are going to say, oh, I don't want facial recognition, even though your iPhone does it every day, right? And they're going to say, oh, what if, China or Russia can hack into it and influence the election? And it's like, well, I mean, what are we dealing with today anyway?
Right. I mean, that's why we're starting with municipal elections, because I'm just pretty confident Putin is not hacking the Colorado Springs school board election, right? And so let's start local. And by the way, if you prefer to go vote in person, knock yourself out. The problem is most people just don't do it. But fundamentally, trillions of dollars a day at this point are moved through the global financial system on phones. People do their love lives, their healthcare. I mean, every major function of your life happens on your phone. We can vote this way too.
And when you say we're developing this, are you working with any startups, or is there opportunities for startups here?
Well, so I've done this all philanthropically. This has all been done out of the Mobile Voting Project, which is a division of Tusk Philanthropies. I've put $20 million of my own money into this. So basically, I made a bunch of money with Uber, and then I spent it on mobile voting. But cities and states don't actually run their own elections. They hire election vendors and companies to do that. And normally those companies have to come up with the R&D and fund it for their area. I've effectively funded it for them because I wanted the code to be open source. And you can't ask a company, especially a startup, to spend all of this money building IP and then just give it away, right? But I can give it away because I'm a foundation. But then ultimately, all of the different companies, and there are startups in that election vending space that are big entrenched interests, they are all welcome to, and we're talking to them, take the code and then work with individual cities and states and sort of adapt it as they see fit. It's like when you mentioned facial recognition, it's an option, right? Some cities might say we absolutely want to use it. Others might say we don't, right? Some might want to say multi-factor authentication is great. Someone else might not want it. I mean, there's different ways that people can choose to do it, but our view was let's build the tech, let's pay for it, let's give it away, and then let the players in the space take it from there.
I mean, aside from cybersecurity concerns and things like that, I wonder if there's space for abuse of this. Like, as we see, we've talked about Uber already. Uber in, 2020 on the ballot. In California, they passed Prop 22, which enshrined workers as gig workers. A lot of people that I've spoken to have called out the amount of money that Uber and other gig worker platforms had spent on advertising to convince people that this was a really good thing for drivers and workers, where that's not necessarily the case and that's not the broad view. So that could only just increase exponentially if everyone is getting bad information, which we know that they're getting online.
Right, totally. So a few things. One is you could easily take the exact same technology and provide nonpartisan information. Like when I was a kid, I remember the League of Women Voters sent a pamphlet to our house saying, like, here are the issues on the ballot, and here are the candidates, and here are their positions. You can do all of that. That would not be touched by either side. That would be by, the government or some third-party group to put that together. But beyond that, look, Prop 22 was a kind of unique thing because it's pretty rare that a group of companies spends over $200 million on a ballot referendum. Normally, it's kind of the other way around. So the taxi industry, just to stick with the Uber example, would give every city council member in some city $5,000 for every campaign. They give the mayor $50,000, and effectively they could then control all taxi policy based on those contributions, right? So right now you have special interests on both sides of the aisle, every imaginable issue that because turnout is really low, like take Section 230, right? One of the reasons that Congress is terrified to try to repeal it is Meta slips into their office and says, hey, I heard you kind of like the idea of repealing Section 230. Just so you know, turnout in your last primary was 9%, and we might drop $3 million against you in the next one if you do vote to repeal Section 230. And guess what happens? Section 230 stays. If you just think about kids, and I'm at this point an independent, I'm not a member of either party, kids get screwed over by Democrats because they're afraid of the teachers' unions' influence in low turnout Democratic primaries, and kids get screwed by Republicans because they're afraid of the NRA influence in low turnout Republican primaries. And so bad policies across the board get adopted. And that's true in just about every industry. So ultimately, if turnout in these primaries went from 10 to 30 or 40 or whatever it is, if we use the NRA as the example, you're a Republican legislator and turnout's 12% in your primary and the NRA are half of those voters, you can't dare defy them because you'll lose your seat. But if turnout goes to 36%, the NRA's vote share is constant, which means it's going to go for the same group of people. So it goes from 50% currently to 16% because now it's 1 out of 6, not 1 out of 2. And all of a sudden, what the NRA wants matters a lot less. And so one of the reasons that special interests have such a grip is because of low turnout. And you can only take away their influence, take power away from the extremes if you can get turnout way up.
So mobile voting. Now, I want to quickly bring things back to not only your equity for services model, but also you have said before that you think that VC is dead at the moment, or it has been dead for the last 4 years. Can you expand on that?
Yeah, I mean, maybe there's some VC that I've never heard of that's been watching liquidity the last couple of years, but we haven't returned $1 in capital to our LPs in 4 years. And some funds have done some secondary sales, but usually, and so they take huge losses on it. Generally speaking, there just has been a paucity of exits of any kind, whether M&A or IPO. Obviously, right now, there's a couple of IPOs that are like testing the water, and we're all watching those very anxiously. But I will say, I think even though I was not a supporter of Trump, when he got elected, there was a moment of optimism that, 2025 is when things are going to open up in terms of liquidity because will be a perception of less regulation, even though in reality, most tech regulations actually stayed local. And Powell had just cut interest rates, and the thought was that would continue to happen. And as a result, and Lena Khan would be gone from the FTC, and there was a perceived chilling effect that she was having across M&A across the board. And the changing in all of those things would all of a sudden open up the floodgates. That has not happened, right, at all.
Well, it's starting to a little bit, right? We've got the Google Wiz acquisition, and some reports have said that, they felt free to try again because there's a new FTC in town. So that could potentially kick the ball rolling. But I feel like we're always hearing about someone that's starting the ball rolling for the IPO market in 2025.
Right. And that is at the very top end, right? That's a $32 billion deal.
Yeah, that's massive.
Right. So most deals are well under $1 billion. Most of it's M&A. Some of it is IPO. So that we haven't really seen yet. I think we're all very much hoping, but there just really hasn't been liquidity for a long time. And that gets back to that earlier discussion we had, which is if you have a giant fund where every year you're taking in $50 million a year in management fees, then you can withstand the lack of liquidity for a very long time because you're making a ton of money anyway, although the LPs are getting screwed over in that scenario. But if you are anything other than that, and you're not really making much on your management fees, you rely on exits to make a living. And that just hasn't happened for a long time.
But what about like the secondary market? A lot of people have been relying on that.
There's stuff, but usually at pretty significant discounts, right?
Right.
Like the secondary market tends, when we have sold into it happily, sometimes we have because we think a company's just going to go to zero and we'll just take what we can get. But putting those sort of situations aside, like Bird, we sold off our whole cost position in Bird to a Japanese hedge fund at a $2.2 billion valuation when the company was soaring, right? Now it's, at scraps, basically. So you wouldn't want to sell in this market to secondary. You want to do it when a company is really hot, where the deal is oversubscribed. And you said, okay, you know what, let me take some risk off the table and I'll exit my cost position so that everything else is just upside. But that's the opposite of this market.
Yeah. And, our editor-in-chief, Connie Loizos, spoke recently on Strictly VC with a VC called Eileen Lee. And she talked about LPs being jaded by funds that went crazy with their checkbooks during the ZIRP era. And they basically threw the money down the drain. And now companies are kind of left to their own devices by investors who've kind of backed off and stopped showing off.
For sure. Look, all of our portfolio companies have basically had to work very hard to manage burn for the last couple of years because, some of them have raised new rounds, but oftentimes not up rounds or smaller rounds than they want. Now, there's a separate world of AI, which is sort of in its own category, as the listeners here obviously know. But typically speaking, for the vast majority of startups, yeah, a lot of them have had to raise down rounds or had to use debt facilities, and a lot of them have gone out of business. And look, that's not all bad from a macro perspective in the sense that the market was wildly overheated. Valuations were way too high. There are too many venture funds. They were competing so heavily for deals that they were paying way too much money for them. And realistically speaking, the exits were never going to be what people thought. Or when companies were going public, you were seeing 60, 70% of the initial valuation at the IPO be gone by the time the lockup expired because the public market said, no, this is not a $30 billion company.
Yeah.
This is a $10 billion company, which, by the way, was probably right. Yeah. So the notion of a correction to bring a level of rationality into valuations and even into VC fundraising itself is not a bad thing at all. But an absolute drought in any sort of liquidity, it is really harmful because keep in mind, I know people are listening to go, oh, those poor rich VCs, screw them. But it's not just us. More important, it's that the whole cycle of innovation in this country relies upon liquidity, right? So startups are able to operate and expand and grow and innovate because they get money from venture capitalists. Venture capitalists can invest in those because they're getting money from LPs, and LPs are giving money to VCs because they're also getting money back in the form of gains and exits. When that whole thing is dry, fundraising really dries up. New funding rounds for startups dry up, so they can't do nearly as much. New company formation goes down because VCs are much more conservative with their money, so they're taking far fewer bets. And so ultimately, innovation gets hindered because, look, as every early stage investor would tell you if they're being totally honest, like, you don't know, right? You're making a founder bet or you're making a market bet. But ultimately, there's 20 companies in whatever that particular idea is, and possibly one or two of them emerge from it and become really successful. Most do not. So just from an overall economy standpoint, not an individual investor standpoint, you want all 20 companies getting funded and created so that one or two can actually emerge and become big companies that can employ tens of thousands of regular people. Right. If those 20 can't get off the ground, it's only one or two and they don't make it, ultimately, that's a real hole. It's also the same reason, by the way, where while I agree that the FTC under Biden did create a chilling effect on M&A overall, I really supported what Lina Khan was doing around big tech antitrust. Yeah. I think for the same reason, and we're starting to see this now with Apple, with their failures with AI, every great company in history eventually stops being great. Eventually, they get slow and bureaucratic and political, and the people who made it great are long gone. And, if that weren't true, Standard Oil and General Electric would be the two companies we'd be talking about right now, right? And so fundamentally, when that happens, and it does happen to everyone, if new companies aren't coming up in their wake, then you're not going to fill the void in the market and in the economy. Yeah. And if these companies have monopolistic power and they can prevent startups from ever getting off the ground because they can just crush all competition, that's really a problem.
Exactly. So there's always been this over-reliance, I think, and I think this is something that Lina Khan has spoken to, that there's been this over-reliance kind of on M&A as like the exit opportunity. And you hear people like, I don't know, Balaji Srinivasan talking about M&A being absolutely necessary, or maybe Vivek Ramaswamy talking about this being absolutely necessary for venture capital to succeed, for the startup industry to flourish, is that you need M&A. But really, like, why not also push, like, if you are only doing M&A, then I think that startups aren't going to IPO as much, and that concentrates all the power and the wealth and the tech among a few. And so now, as you said, Lina Khan's reign over the FTC, which I thought was great, I think is having a chilling effect, but we're seeing another chilling effect happening in the markets today, I think, right? So Klarna recently filed for an IPO. Who knows how that's going to go once they actually make it to the markets and once the markets have had some time to relax. But clearly the markets are like, I don't know what to do right now with this current political situation.
Yeah.
Really quickly, I wanted to ask, there are still founders out there trying to make a living, trying to build tech that changes the world. Briefly, what is your advice for them in this 2025 chaotic mess?
Yeah, I mean, I would say this, especially any early stage founder, it's going to be years and years until from when you're sort of starting things now until there's some sort of resolution to your company. Trump will hopefully be long gone by then one way or the other. So just keep your head down, do what you're doing. But one thing that I think maybe I'm qualified to speak to that is worth saying is if you are in a regulated industry and if you touch a consumer in any way, directly or indirectly, you are regulated somehow, you have to understand what the regulatory climate is. You have to understand what the laws are, who's on what side, if you're disrupting someone, who you're disrupting, what their relative political power is. If you're in a white space where there is no existing regulatory framework, what you need in order for your industry and product to actually work and be saleable. In the same way that you have to take engineering seriously and go to market seriously and everything else, if you ignore regulation completely, it could be incredibly detrimental to you. And so if you're in a startup like energy or healthcare or education or transportation or gaming or fintech and you're regulated, take the time to learn what you're facing because otherwise it may cost you a tremendous amount more on the back end.
Amazing. And I'm sure, startups would also love to come to you and your firm for this kind of advice. So where can our listeners connect with you?
TuskVentures.com. You can go find me on LinkedIn, BradleyTusk.com. So there's lots of different ways to reach me.
Just Google him,
Yeah, you can Google me. And then look, I'm supposed to plug stuff. So
yeah, plug it away.
I have a podcast called Firewall. And if you like this is the kind of stuff we talk about. So check that out too. I've got a Substack about all this stuff. So again, if you like it, this is the kind of stuff that I write about. Yeah, if you were ever in Manhattan and you were looking for a book, I own an indie bookstore in the Lower East Side called P&T Knitwear. It is a indie bookstore.
I love that store. No way. It's so
you've been
cute.
There?
Yes.
Oh, yeah. That's my store. It is the worst business ever. I lose so much money.
But it's really nice.
Yeah. We're also the only free podcast studio in New York. So if anybody wants to record a podcast, you can just sign up on our website. We've got an event space that we let the community use pretty much every night. So check us out if you're around. We're doing the best we can because I love books and I want to give this to the community.
Oh my God, that's amazing.
That's so cool that you've been there. I'm thrilled.
Yeah. Well, thanks again for joining us on the show. And to our listeners, you can find me on X and on Blue Sky. And you can find Equity at EquityPod on both as well. Talk to you next time. Equity is produced by Theresa Loconsolo with editing by Kell. We'd also like to thank TechCrunch's audience development team. Thank you so much for listening, and we'll talk to you next time.